The chart says late April buying interest creates a timely reason to explain why India can decouple from headline gold quotes. Looks manageable while the physical market underneath it is tightening. That contradiction is the part most coverage skips, and it changes the stacker math faster than the headline suggests. This setup matters because India's $350 gold premium, 3 real drivers heading into April 30th, buying is not just a headline story. It can change the math for 350 faster than most holders expect. Stay with me, because the key signal is not the loudest one. It is the one that changes what happens next. By the end of this video, you'll know exactly which signal matters most and what it means for your next move. And I'll translate it into what it means for a real stacker, not just another macro recap. A premium this large in a major buying market rarely appears for one neat reason. Usually it is a stack of pressure points working together. Import friction, delivery urgency, dealer inventory strain, and buyers deciding the next ounce matters more than waiting for a cleaner chart. That is why this setup matters before April 30th. If replacement cost is already separating from spot in India, stackers need to know whether that spread is noise, timing, or an early warning that physical demand is firmer than the paper market wants to admit. Start with driver number 1, import tightness. India does not satisfy its gold appetite from domestic mining. It relies on imported metal, refining channels, banking routes, wholesaler inventories, and local distribution. That means the premium can widen even when the global quote looks stable, because India is not pricing abstract gold. It is pricing deliverable gold inside the country, in the right form at the right time. And that distinction is bigger than it sounds. A global benchmark can be set by huge volumes of paper claims changing hands in seconds. But a local premium appears when actual bars, coins, or jewelry feedstock are not arriving smoothly enough to match demand. Sometimes that is logistics, sometimes it is financing, sometimes it is dealer restocking, sometimes it is simply that supply is available, just not available cheaply or immediately. In a physical market, immediacy has a price. That is why a premium like this should not be dismissed as some random retail exaggeration. If dealers, wholesalers, and buyers are paying up to secure metal ahead of a buying burst, the premium is telling you the market values possession more than the headline quote suggests. The West can still be debating inflation prints, bond yields, and central bank language, while India is bidding for actual ounces. For you, that means the screen price is not always your shopping price. If you are trying to add 1 ounce before month end, the difference between a quiet chart and a tight local market can wipe out the bargain you thought you were waiting for. If your plan is 3 ounces, even a moderate premium shift can be the difference between buying confidently now or chasing availability later. If you are looking at 5 ounces or more, local tightness matters even more, because physical pricing can move before the futures chart gives you permission. Now, driver number 2, and this is where the timing matters, the late April buying wave. The reason I would not shrug off this premium in mid-April is that demand heading into April 30th is not just speculative demand. It is culturally embedded, seasonally concentrated, and often far less price sensitive than Western traders expect. When households, jewelers, and dealers all lean into the same window, the physical market does not wait for Wall Street to feel comfortable. It starts repricing metal where the buying is happening. This is the part many Western viewers underestimate. In the West, a dip can scare buyers away for a week. In India, a dip can bring buyers in. A rally can also bring buyers in if the intention is accumulation, gifting, or preserving savings into a specific date window. That is why these markets can look irrational to paper traders. They are not irrational. They are serving a different purpose. When that demand pulse arrives, jewelers restock, wholesalers defend margins, and physical inventory gets spoken for quickly. Even people who are not buying large bars feel it because the whole chain tightens together. A market like that can decouple from the paper quote faster than most commentators are willing to admit. The futures chart still says gold is range bound. The physical market says try getting immediate metal at that price. And this is where the East versus West split becomes impossible to ignore. The East accumulates when it sees value, security, or timing. The West often waits for confirmation from financial markets first. So while Western traders are asking whether gold deserves to break higher, Eastern buyers are asking whether they can still secure ounces before the crowd gets there. One mindset is negotiating with a chart. The other is taking inventory out of circulation. Bring that back to your own bag size. If you are buying 1 ounce, this is your warning that a lower spot print does not automatically mean a lower out-the-door cost. If you are building toward 2 or 3 ounces, a demand window like this can close faster than you expect, especially if dealers start protecting stock. If you are a 10-ounce buyer over the next few months, you should be paying attention now, because these local pressure points are often the first sign that the benchmark price is lagging the physical market. If you track physical premiums more than headline spot, hit like on the video. That tells me to keep breaking down where the real metal is moving, instead of just repeating the paper narrative. Now let us widen the frame, because this is not only about India. India matters here because it is visible, but the broader signal is East versus West. The East has been willing to accumulate physical metal while the West keeps trying to trade it through financial wrappers. You see that tension whenever physical hubs in Asia or the Middle East start paying up while Western benchmark pricing looks tame. The message is simple. Gold in hand and gold on a screen are not always being valued the same way. That takes us to driver number 3, paper suppression, or at the very least, paper lag in the West. I want to phrase this carefully because you do not need a dramatic conspiracy theory to understand what is happening. Western price discovery is built on a structure where enormous amounts of gold exposure can be created, hedged, sold, and rotated without anyone taking delivery. Futures, forwards, options, ETF flows, and macro positioning can dominate the conversation for long stretches. That makes the price highly sensitive to financial narratives, and sometimes not sensitive enough to physical tightness. A paper-heavy market can absorb bullish physical signals for a while because it has more ways to express caution. Funds can sell into strength. Traders can fade rallies on rate expectations. Hedges can cap momentum. Commentators can keep pointing to a strong dollar or a calm bond market. None of that creates more physical gold in India. It just means the benchmark can stay flatter than the physical market deserves. This is why stackers so often feel like the chart and the coin shop are living in different worlds. They are, at least temporarily. A paper ounce can be sold instantly. A real ounce has to be sourced, moved, financed, fabricated, and delivered. When the East is pulling metal toward physical ownership and the West is still comfortable trading claims, the friction shows up first in premiums, not always in spot. And that is the hidden truth inside a premium like this. It is not merely that India is expensive. It is that the benchmark may be too cheap relative to the urgency of actual buyers. The paper market can tell you sentiment is mixed. The physical market can tell you metal is wanted now. When those two messages diverge sharply, I care more about the one that requires cash and delivery. For your own ounces, this matters immediately. If you are buying a single 1 ounce coin, you need to understand that waiting for a $20 or $30 dip in paper may save less than a tightening premium can cost you. If you are aiming for 5 ounces, a market that looks flat on paper can still become meaningfully more expensive in physical form. If you already hold 10 ounces and plan to add, this kind of premium is less about panic and more about timing. It says the cheap, lazy patience trade may be ending before the chart makes it obvious. And here is the point where I think the Western narrative is weakest. It keeps assuming physical buyers will eventually blink. Sometimes they do. Sometimes demand cools, premiums narrow, and the benchmark turns out to have been right. But when a premium stays large into a known buying window, the better question is whether the benchmark is late, not whether physical buyers are foolish. The East does not need Western permission to revalue metal locally. It just needs enough buyers willing to exchange currency for ounces. If this is how you think about metals, subscribe. This channel is most useful when the market gets messy, because that is when the difference between paper comfort and physical reality matters most. So what should a real stacker do with this information before April 30th? First, stop assuming a red candle on the chart automatically means a better physical entry. In a market like this, the cheaper screen can be the bait. You wait for a paper dip, premiums widen, and your actual checkout price barely improves or even gets worse. That is how people lose good entries while believing they were being patient. Second, separate urgency by size. If you need 1 ounce and you have no core position, your goal is not perfection. Your goal is possession at a reasonable total cost. If you want 2 or 3 ounces, you should be comparing local premium behavior more closely than headline spot for the next 2 weeks. If your plan is 5 ounces or 10 ounces, think in tranches: 1 buy before the late April rush, 1 buy only if paper weakness actually shows up in physical offers, and 1 reserve in case the West finally catches up to what the East is already signaling. Third, use the premium as a pressure gauge. A roughly $350 premium is not just a number to repeat in a title. It is a message that immediate metal in one of the world's biggest physical markets can command a very different price than the benchmark most investors quote all day. When that gap is wide heading into a buying window, I do not treat it as trivia. I treat it as a warning that the market you can actually buy from is tighter than the market you are watching on screen. Tell me in the comments whether you are waiting for spot to pull back or adding before April 30th, and tell me your size: 1 ounce, 3 ounces, 5 ounces, or 10. That is the only way this conversation becomes useful, because the right move for a 1 ounce buyer is not always the right move for someone building a 10 ounce position. Now let us close the loop on the question from the beginning. Which price is real? The answer is that the more honest price, especially into a concentrated buying window, is usually the one that clears physical metal when real buyers want it now. That does not mean the paper market is irrelevant. It means the paper market can be late. India paying a major premium into April 30th suggests the East is valuing immediacy, possession, and local availability more aggressively than the Western benchmark is admitting. And that is the signal I would respect. The East is accumulating, the West is still negotiating with paper. When those two markets diverge, I do not assume the side demanding delivery is confused. I assume the chart may still be catching up, and this is why timing matters for stackers. A large India premium does not guarantee a global squeeze tomorrow, but it does tell you where urgency is already showing up. If one market is paying materially above the reference quote just to secure metal before a known buying window, then waiting for perfect chart confirmation can be more expensive than most people expect. Even if the premium narrows later, the fact that buyers were willing to pay up this aggressively before April 30th tells you demand is not waiting politely for the paper market to validate it. That alone is useful information for anyone deciding whether to buy now or assume a calmer window will appear later. That is why replacement cost, not just spot, deserves the attention here, and that is the practical signal stackers can actually use before the window closes. That is the whole point for buyers trying to act, not spectate. For a real stacker, late April buying interest creates a timely reason to explain why India can decouple from headline gold quotes. Matters only if it changes what ounces cost, how fast physical pressure is building, and whether waiting gets more expensive. If you hold 350, that is the part worth watching. A real stacker should leave with one concrete shortage signal to watch and one practical reason the next buying window could get tighter. If you want more signals like this, stay with the channel. We are going to keep tracking where physical demand is exposing the gap between East and West, because that gap is where a lot of bad assumptions get broken. Like the video if you want more premium breakdowns, subscribe if you care about physical reality over paper comfort, and comment with your ounce target before April 30th so we can see how different stack sizes should respond. One more thing matters here. If this premium holds, it changes how you should interpret the next few trading days, because persistent physical stress usually leaks into pricing behavior in stages rather than all at once. Show which delivery, vault, or buying signal matters most, and what it changes for physical availability and timing. A real stacker should leave with one concrete shortage signal to watch and one practical reason. The next buying window could get tighter. The point is not to memorize one headline, it is to understand which outcome is being confirmed and which one the paper market is still slow to price. Now you understand what this means for your stack. If the third outcome appears, you do not wait for a mainstream headline to validate the move, because the premium itself is already telling you where the stress sits. A real stacker feels that shift through replacement cost, availability, and timing pressure long before a polished headline explains it cleanly. That is why the premium story matters, even when the benchmark still looks calm. The people who understand that gap are usually the ones who respond before the easier inventory disappears.